Have you ever calculated how much extra money you hand over to a bank just for the privilege of stretching out a loan? Not the estimated monthly payment Zillow shows you, but the actual total check you write over decades? Most people get a knot in their stomach somewhere around the second line of that calculation and quietly close the tab. It's not just you, and it's not because you haven't budgeted enough. The mortgage paradox is that the people who choose a 30-year loan usually think they are playing it safe, while those who take a 15-year loan think they are being financially disciplined. Yet, two home buyers can purchase the exact same $400,000 house on the exact same day, and one hands the bank $250,000 less in interest, while the other builds a liquid multi-million-dollar stock portfolio using the exact same property. Nothing about their income separates them. What separates them is a filter almost nobody checks: the friction between guaranteed interest savings and opportunity cost. The moment you sign a mortgage note, simple interest stops being trivia and starts deciding your entire financial trajectory. Understanding that choosing a mortgage term is an opportunity cost problem, not a debt phobia problem, is the first step to making sure you land on the winning side of that math. There are 3 levers that control it, and by the end of this script, all 3 will be yours. Let's run the experiment properly, because the claim I just made sounds counterintuitive, and counterintuitive claims deserve a controlled test. Take a standard $400,000 home purchase with a 20% down payment, leaving a $320,000 loan balance. Hand that exact loan to 2 identical buyers with the same income. Call them Alex and Sarah. Alex takes the standard 30-year fixed mortgage at a historical average interest rate of 6.5%. Sarah takes the 15-year fixed mortgage, which gets a lower rate of 5.75% because the bank assumes less long-term risk. First, look at the plain monthly numbers. Alex pays roughly $2,022 a month in principal and interest. Sarah pays $2,658 a month. Sarah's payment is over $630 higher every single month. Now watch what happens over time. Sarah grinds through 15 years of higher payments, but because her loan term is cut in half and her interest rate is lower, she pays a total of roughly $158,000 in interest over the life of the loan. In year 15, her mortgage is officially zero. Alex, on the other hand, keeps paying his $2,022 every month for 30 full years. By the time he burns his mortgage paperwork, he has paid roughly $408,000 in pure interest. Same starting home, same loan amount. Yet Alex paid over $250,000 more to the bank than Sarah. One variable changed the ending: the length of the debt contract, and the trigger that armed that variable was amortization speed, the rate at which your monthly check actually cuts into the principal instead of feeding bank profit, which means this isn't only a story about debt-free living versus lifetime payments. This math switches on anytime you trade lower monthly liquidity for guaranteed interest reduction. 30 years is simply where the mechanism is easiest to see. So, let me show you the mechanism one step at a time using Alex's 30-year mortgage first. Year 1. Alex makes 12 monthly payments totaling over $24,000. Out of that massive pile of cash, nearly $20,000 goes straight to bank interest. Less than $5,000 actually touches his loan balance. Year 5. He is still sending over 75% of every check straight into interest. Year 15. He reaches the halfway mark in time, but he has barely chopped off a third of his original debt. Notice what is happening. The 30-year mortgage is front-loaded with interest. Alex gets maximum monthly cash flow flexibility. His mandatory bill is $636 lower than Sarah's, but his equity growth moves at a snail's pace for the first decade. Watch. What happens to Sarah on the 15-year side during those exact same years? Year 1. Sarah sends her higher payment. Because of the shorter time frame and lower rate, Over 50% of her very first payment goes directly toward paying down the house itself. Year 5. The majority of her check is pure equity accumulation. Year 15. While Alex is still struggling through the heavy interest curve, Sarah owns her home free and clear. That is the mechanism in one sentence. A shorter amortization schedule forces rapid principal reduction from day one, neutralizing the bank's compound interest trap. Meanwhile, Alex has been holding on to an extra $636 in cash flow every single month. And now the quietest fact in this entire debate. What if Alex doesn't waste that $636? What if he invests it? Run Alex's numbers forward and ask a simple question. If Alex takes the $636 he saved every month by choosing the 30-year loan and automatically deposits it into a low-cost S&P 500 index fund, compounding at a historical 8% net return. Who ends up wealthier at year 15? And who wins at year 30? At year 15, Sarah has a fully paid-off $320,000 house and $0 in mortgage payments. Alex still owes money on his house, but his investment account has quietly grown to over $215,000. Now push the experiment to year 30. Sarah, having paid off her home at year 15, starts investing her entire $2,758 monthly payment into the same index fund for the remaining 15 years. Alex simply keeps investing his $630 every month for the full 30 years. At the end of 30 years, both own their homes completely free and clear. But Alex's investment portfolio has compounded to over $900,000, while Sarah's portfolio sits at roughly $920,000. The math ends in a near tie. The magic was never the 15-year mortgage alone. The magic was what happened to the spread. So if the ultimate wealth outcome can end in a tie, a better question is, how do you choose between them without relying on luck? Comparing total interest paid alone can't answer that. That can be misleading. Analyzing life scenarios can. Take those two mortgage paths across different economic environments. If you lose your job or face an unexpected medical crisis on a 15-year mortgage, the bank still demands that higher mandatory payment every single month. If you default, the equity locked in your house doesn't buy groceries. On a 30-year mortgage, your mandatory obligation is drastically lower, giving you a wider safety margin during financial storms. Sort the choices by one thing only: discipline versus flexibility. The 15-year mortgage is a forced savings mechanism. It protects you from your own worst habits by guaranteeing a debt-free house. The 30-year mortgage offers maximum optionality. You can voluntarily make 15-year payments when times are good, but drop back to the lower payment if life gets expensive. The answer isn't picking one based on fear of debt or blind loyalty to investment calculators. It's building around the three levers that dictate total return. Lever 1 is guaranteed rate of return. Every dollar you pay toward a 5.75% mortgage is a risk-free, tax-free return equal to 5.75%. Lever 2 is liquidity and optionality. Equity locked inside home walls is illiquid. Cash invested in liquid paper or kept in high-yield reserves gives you operational control. Lever 3 is inflation decay. Over 30 years, inflation degrades the purchasing power of money. The $2,020 payment Alex makes in year 25 will feel significantly cheaper in real dollars than it does today. While his property value inflates, the buyer who takes a 15-year mortgage gets peace of mind and forced equity. The buyer who takes a 30-year mortgage and disciplinedly invests the difference buys financial flexibility and compounding upside. The question most people ask is, which loan saves me more money? 30 years of data demonstrates that both can make you wealthy if executed correctly. The question that actually contains the answer is, do I value guaranteed debt elimination today or liquid flexibility for tomorrow? The math is on the table. Run yours before you sign.